we have the raw talent and capability and entrepreneurship and mindset to create huge disruptive companies.
The New Zealand Tech Podcast, brought to you by Gorilla Technology, proactive and strategic IT.
Greetings and welcome along to the New Zealand Tech Podcast. I'm your host, Paul Spain, and today real privileged to have James Pinner with us from the New Zealand Growth Capital Partners. Welcome along, James. How are you?
Very well, thanks. Thanks for having me.
Great to have you here on the New Zealand Tech Podcast. First time we've heard from NZGCP,
Yep.
So maybe you can just give a quick intro to yourself.
Sure.
and where you fit into the picture.
Yeah, I'm James. I'm the CEO of NZGCP. I've been with the organisation for 6.5 years now. NZGCP is an agency set up by the government to help build a startup ecosystem. So we're really about trying to mobilise more capital, get more startups flowing through, and bring more capital into the space so they can grow and have huge impact on New Zealand. So I've been joined to set up the Elevate Fund, which is our fund of funds, investing into venture capital funds. And now I've just recently taken over at the helm of CEO from 1st of January.
Congratulations.
Thank you.
It's exciting.
Yeah.
Well, before we kick in, of course, a big thank you to our show partners, One New Zealand, 2 Degrees, Spark, Workday, Fortinet, and Gorilla Technology. Really appreciate their support of the overall tech and innovation ecosystems in New Zealand. Well, let's jump in. I'm keen maybe start at the beginning of the NZGCP story, sure, or New Zealand Venture Investment Fund as it started out.
Yeah.
What can you tell us around how that all came about and what the world looked like back in 2002 from a tech startup and venture capital perspective in New Zealand?
Sure. Yeah, and obviously I wasn't quite around at that time. I hail from the UK originally. I've been over. I actually was around in 2002 and 3, but then I went back to London. I've been here 12 years. But NZVIF was set up as it was then as a fund of funds, so investing into venture capital funds. It did invest into quite a broad range of funds at the time, and the reality was there were some really good startups being formed around the time. Sort of we got the Zeros and the Trade Me's back then, but it wasn't quite a depth of market that was there. So in 2007, the idea was sort of transformed a little bit to set up the Seed Co-Investment Fund, or SCIF as we called it back then. And that was really to try and stimulate direct investment into startups. It was a matching capital kind of program that would work with accredited investors, like especially a lot of angels and early stage investors. And that's been going and morphed till about 2020. So the NZVIF, the fund of funds, was winding down in the mid to late 2010s. The SCIF program was carrying on, and we've been recycling capital from those programs. In 2020, we launched the Elevate Fund of Funds, and that was an opportunity to take a bit of a look at the seed model and the Aspire model and move to a slightly more commercial mandate. So we are now making, and for over 6-7 years now, been making our own investment decisions on the direct side of things, but also on the venture capital fund. So we're managing the Elevate Fund, which is on behalf of the government.
I mean, looking back to those earlier days and the sort of 2002 era, there was certainly some things sort of going on, but the world has changed quite a lot over that period of time.
Yep.
You mentioned, investing into existing, venture capital funds. What was around it at that time compared to what the landscape sort of looks like today? Because it seems like there's a lot more that's going on venture capital wise, and it seems like the government involvement through this journey is an important part of that picture.
Yeah, absolutely. And I also look back to when I joined in sort of 2019, just prior to the Elevate launch, and there was, like I said, there was startups being formed. The actual amount of available capital for venture capital at that stage was only $72 million. So there was 1 or 2 managers at the time. Blackbird was the most established fund manager in the country. Blackbird was just becoming, so Movac was the most established, Blackbird was just coming in, there was GD1 and a few funds being formed. And then we estimate that sort of from as far back as the data goes, so sort of around at 2001 to, there's about $1.2 billion invested into the VC from, let's say, 2002 to 2020. Since 2020 to 2025, we've had over $1.8 billion. So a 50% uplift in 5 years compared to the previous almost 20 years. So we're seeing a lot more going in. We've got a lot of a few more managers now with track records emerging, which is what investors need to actually sort of give them confidence to invest into. We're seeing a much broader range of venture capital funds coming in locally, and a lot more startups. So our estimates are around sort of 1.5 to 2,000 startups live at the moment, which is definitely a significant lift from where we were. We've still got a long way to go, so we still think we think there should be more like 5,000 startups for a country of our size, which does mean more capital at all stages. But yeah, the government support that's been shown has been instrumental in lifting that and sort of crowding in private capital, which is exactly what we want to do.
Mm. Now, I often hear that New Zealand startups are, seem to be sort of somewhat undervalued compared to the valuations that would get put on, say, company, a startup, based in Silicon Valley. Is there some truth to that from your perspective?
Yes, there is. There's always the exceptions that prove the rule, and you'll get we see it in round sizes, we see it in valuations, and so on. That the scale of investment into New Zealand companies is significantly lower than the equivalents in Silicon Valley. And we have to be careful sort of comparing ourselves to Silicon Valley. Silicon Valley's been around for decades and decades. There's 300 million people there. It's always going to be a bit bigger, more competitive, which drives valuations up. But our aim is to get New Zealand companies onto that global stage. So get them there quicker, get them, we're looking for globally ambitious companies that are going to space. And we've seen great successes like the Rocket Lab, for example, which, struggled to get money domestically at the time, has really, now really, excuse the pun, taken off and is doing very well listed in the US and is able to access much larger pools of capital. And I don't think we're ever going to solve or should want to try and necessarily solve that later stage sort of capital piece. We're always going to be able to build a pipeline to the US sort of Series B onwards, kind of if a later stage investment capital is there. Globally, the markets are always going to be bigger outside of New Zealand than they are here. So companies should always be and will always be looking to go into overseas markets. There will be greater talent pools overseas, but that doesn't mean we shouldn't be trying to do a lot more here. So we do want to keep companies here longer. We want to give them better chances of success. So more capital stays, is invested earlier in New Zealand, which is then recycled out of the successes. We get to build talent and keep more people here. So maybe people keeping more their R&D facilities in this country and the headquarters here, still sending people into overseas markets to get access to those markets. But I think it's an and. We shouldn't be looking for one or the other. I think if we can keep growing the base and keeping companies here for as long as possible, but giving them the best sort of launch pad to get into overseas markets, that's our ideal.
Yeah. And do you have a view on sort of success rates? Because often, certainly looking at Silicon Valley, it's like the metrics there are obviously different and different in every part of the world. There we see firms that end up being $1 trillion type firms. It seems in Silicon Valley that there's maybe some really, really big successes, but maybe more failures overall. Is that what do the stats kind of look like in terms of failures? Certainly, when I look at the sort of most of the startups that I have interacted with over the last decade or so, and maybe it's just because I end up talking to the ones that are really good and already very well on their path by the time they kind of come onto the radar. But it seems like we have a pretty high success rate compared to sort of some of the overall stats.
Yeah, and it depends how you measure success. Obviously, you're right. We haven't had any $1 trillion companies yet. I hope we do. But we do seem to punch above our weight in terms of creating unicorns or $1 billion valued businesses. We've got, Halter's one of the more recent ones, and then you've got sort of the LanzaTechs and the Rocket Labs and Zeros that we've had over the years. But I'd say it is sort of almost a game of two halves. We are taking longer. New Zealand companies, partly because of the capital raised and there's less capital going into these companies. We do take longer to get there, so than our competitors, and in global markets, especially where you've got, you just be able to put more money to work, you're able to hire talent to move quicker. So we do take longer to get there, and we have this sort of dialogue and sort of conversation around, well, New Zealand is a very, very capital efficient. We are able to do more with less, which is a great imperative and a great trait to have. But at the same time, I don't think that should be our narrative that we should lead on. Or an excuse not to have companies properly funded and to be able to compete on a global scale. So I'd say our failure rates overall are fairly similar. We do also have a little bit of a habit of holding on to companies for too long in New Zealand. We don't like to let companies go, and you can never know to prove the negative. But and maybe some of the companies that were successful, if someone hadn't given them a go, we'd certainly know that's the case. Then they wouldn't have become a success. But there is certainly and the US in particular and more established markets are much more open to letting a company fail quickly, recycle that talent, so that founder's now going on to work on a different program or different initiative, but they've got more experience and lived experience, which is what serial entrepreneurs are generally much more successful than sort of first time statistically. So yeah, I'd say we have the stats show that we are able to, let's say, sort of punch above our weight in creating those big companies. And I think that's the general underpinning of why we fundamentally believe this will work. We have the raw talent and capability and entrepreneurship and mindset to create huge disruptive companies. And New Zealanders have historically, broken the norms and created these huge things, whether it's and it's Rutherford splitting the atom, or Bruce McLaren, or we all know the stories of the famous New Zealanders, Edmund Hillary. So we have that raw talent, and if we can get behind that, if we didn't have that, that would be, you can't force that. Whereas putting capital to work and supporting those companies grow is something that we can replicate and do.
When you look back over this, history, NZGCP, NZ over sort of 20, 24 years, is it clear that it's been a good investment and good thing for the government to be involved in? What are the things that sort of stand out to you?
Yeah.
If you look at that journey, wherever politics is involved, some things can get kicked to the curb. Pretty quickly. It's actually a reasonable period for. I mean, obviously there've been changes and so on along the way, which these things need to often need to happen.
Yeah.
But you're still here. So
yes, yeah, and I would say this, but I generally wouldn't be here unless I thought we had a really important place to play. I'm here because I want to do this for New Zealand, and the benefit that technology companies have for New Zealand is there. And I think even the data, without me sort of the partisan sort of saying this is definitely a good idea, I think the data shows that as well. Like if it goes from the capital in the Series A, B stage, like I said, sort of it's gone from 1 billion over 20 years to $1.82 billion over the next sort of last 5 years. We've had great successes in terms of some of the startups we've backed, and even financially. And this is one thing we have to sort of measure or sort of think about as an NZGCP. We are responsible for taxpayer money, so we are custodians of that, and we don't want to lose money. But actually our primary role is economic and market development. So we're trying to build a market. We're trying to get more startups there. We're trying to get more private capital into this space. And our actual real goal long term is the economic impact we have for New Zealand. That's why we believe in it, and we want to be so successful. But at the same time, as I said, we're custodians of taxpayer money, so we don't want to be losing money. So we're trying to find that sort of sweet spot to balance that. So in NZGCP, for example, we haven't actually been funded since 2017. We get a small appropriation each year for market development, which we put into sponsorships of key initiatives. But we have been basically recycling and reinvesting from realizations we've made in our own portfolio. That covers all our operating costs and all our new investments. And we had a really good exit a couple of years ago with Kiwi, which is a company that we first invested sort of 14 years prior. It's a long journey. So from a financial sort of point of view, I think, we're more than keeping our nose clean. We're actually making the returns and relatively self-sustaining. That said, I think we're massively under scale, and I think we can do a lot more. And I say that because of the impact we're having in some of these companies. So we've invested directly from our seed fund, Aspire, previously Skiff, coming up to 300 companies now over that period. There's been some great successes, and a lot of those companies are still maturing now and then are getting into the pipeline. Whether it's an OpenStar, for example, or Volumio and Avasa, some of these newer companies that we've been backing, and so we are building the pipeline of future economic growth, and on the Elevate side of things, then sort of bringing that private capital in, and that sort of Elevate, for example. So we've had $400 million committed from the government so far over the last 5 years. We've already realized $20 million of exits through companies like Tradeify and Quantify Photonics. And those companies, the 13 funds, they've almost invested in, it's almost coming up to 200 companies themselves over the last 5 years. So that's 500 startups we've backed. And there's the economic benefit, and this is, startups are a power law game. There's one or two winners make both the financial returns, but actually the productivity gains. And I'll come back to productivity because we all know that's really important to New Zealand, and we've been sort of lagging a bit, to put it a bit mildly.
Yeah.
But those power law companies are the ones that create thousands of jobs. And, we look at how many people Rocket Lab's employing, Xero, and also the spin outs of those. So Xero, I think, claim that through their sort of, as they've grown, they've created 1,000 spin out new companies that have come. Rocket Lab, we've already seen, lots of companies already being formed from people who used to work there. Rocket Lab, I think they've created 150 millionaires from some of their early employees. That's money that can come back into the ecosystem and is raising the prosperity for New Zealand. So not only is the sort of power law companies, those big companies creating big jobs and having big economic impact, all those employees are paying taxes. These are high paid jobs. These are opportunities to raise the base. But even the ones that fail, like, the ones that don't become the $1 billion companies, they're still hiring people along the way. They're still developing talent. So the knock-on effects and the spill-off effects for every single thing that the startup ecosystem is doing are pretty phenomenal. And then, productivity. The McKinsey published a recent report which shows that productivity gains follow a power law. So, and to such an extent that a small number of companies can actually lift nationwide productivity. So we go back to the US, and a small number of companies like NVIDIA and Meta and Amazon, Apple, they actually lift nationwide productivity because they're so impactful. So if we can have that, I don't think it's necessarily, there's an element of, all these tech companies, and I'm sure we'll come on to AI in a second. These will have incremental increases in productivity, but actually having some true nation-building tech companies like Rocket Lab, that is building nationwide productivity, and that's sort of the heart of. I think that's how we shift the nationwide productivity. It's not about.
So you're talking about lifting our overall kind of productivity stats. I guess Rocket Lab's not necessarily changing the productivity inside every New Zealand business, like a software vendor whose software gets rolled out. But when you look at the return sort of per head and so on,
and also like I said, sort of high paid jobs as well. So it's bringing in more tax revenue, and that's the thing. If we can get more of these companies growing the economic pie and growing productivity, tax take, exports, that helps everybody. That helps us pay for all the infrastructure we want as a country. It helps us pay for a world-class education system. The knock-on benefits of that, and hopefully as well along the way, solving some of the climate problems and things like that. We seem to be doing really well in that at the moment.
You mentioned Cami. What can you share about Cami's story? I think that's probably quite an interesting one, for listeners, and be interested in what your thoughts are on that journey from investing through to exiting.
To quote them, really, because it's their story. But when Skiff invested in them, there really wasn't much capital around, and if it hadn't been for the matching capital that we provided at the time, they really wouldn't have been able to get off the ground.
This was at the sort of seed funding, foundational level.
Yeah. And we've had multiple stories. Aura is another great example where they've literally said to us that if it hadn't been for that funding, they wouldn't have got to, even through some of the first steps. And that's what we're trying to do. We come in at the earliest stage to help companies get off the ground. Back then, and still to some extent, there wasn't a lot of private capital. We all know a lot of New Zealand sort of private capital goes into properties and doesn't really, go into space. At the same time, this is a really, really risky stage. Like the earlier stages is, most of the private investors, when we're talking to big venture capital funds, they want to come in when things have been de-risked a bit, you've got, especially in software, you've got some revenue, recurring revenue building up. So they don't want to take the early stage. So that's generally sort of people like governments do back this, whether it's through incentives and tax or through direct investment like we're doing. You've got angels who are generally wealthier individuals who can afford to sort of have more risk appetite and support, giving back generally.
Yeah.
So that's what we did with Cami and Aura, and if it hadn't been for that capital at the time, they would never have progressed and grown to become what they became. Cami, the Cami founders, they are now using some of the capital they've taken from the exit and are now setting up their own fund. And this is like the next generation of investors coming forward, which is fantastic.
Yeah.
We, as a fund, we made an 80 times return on our investment. So they gave us, give or take, about $40 million to then reinvest into the next generation of startups. So hopefully that 40 million creates 6 Camis, not 1 Cami, and that's our ambition as well, is to these unicorn companies, these $1 billion businesses, we're not doing one every 10 years like we have been. We're doing one a year. That's what we really want to get to.
Yeah, that's exciting. And where does the New Zealand Super Fund fit into the picture?
So they are essentially mandated to look after the Elevate Fund. So under legislation for Elevate, the money was sort of ring-fenced and taken off from NZSuper and put into a separate Elevate fund. They've appointed NZGCP as the day-to-day manager of that fund. So we make all the investment decisions, we do the monitoring and reporting, and then we report to them. We call it an LPAC, a Limited Partner Advisory Committee, which is very like a board, really. It adds an extra layer of governance. So they're governing it, the actual accounts go into NZSuper's annual report, but we do the managing of the day-to-day making decisions.
And for those that aren't aware, that the New Zealand Super Fund, this is our superannuation sort of future for New Zealand, right?
Yes, and I think it's valued at around 85 billion now, and it's been one of the most successful sovereign wealth funds in the world actually over the last decade. So and longer probably. Yeah.
In terms of the challenges of running an organisation like New Zealand Growth Capital Partners. What does that look like? What can you tell us? Because these things aren't all easy, and it's great when there's a really good sort of return on investment, and when things are going well. But no one runs a perfect organisation. Perfectly through history. I don't think we've got any examples of that.
And we're only human, like
right.
We can all do make mistakes. I mean, as long as we learn from them, that's simple.
Yeah. So, I mean, what can you?
Where do I start?
What can you share? Any particular stories that?
I guess even just to the context of why we exist. So we invest in startups. The idea is of the companies we invest in these are really disruptive, huge global businesses. That is incredibly risky, and probably over 95% fail. We invest at the earlier stage, which is the riskiest stage. So we have a very high portion of failures in our portfolio, and all of the failures happen before the winners. So as you're along that journey, you're constantly having companies don't quite make it, fail. Some of them, when you say a failure, that's not necessarily they've gone into insolvency. They just haven't sort of become that $1 billion, sort of $100 million revenue company that you hope they would be. And they're still having really meaningful impact. But a lot of them do fail, and they take on big risks. And we have things in our portfolio like OpenStar, which is, we call it a moonshot. If it comes off, it's fantastic. It could have global impact on energy. But it's incredibly risky and incredibly hard, and no one's been able to do it before. So we have to back those things to give them a go, but we also have to be realistic. A lot of them won't get there. So that's the sort of general premise of what we do. We're also investing in the venture capital market, which, as I said, when I joined, there was sort of one or two managers that had sort of track records. There was basically everyone else was what we call an emerging manager or a first-time manager. So, and again, investing in venture capital is a very long journey. You're generally investing in things that your portfolio will mature after, so say 7 to 10 years we talk about, and especially if you're sort of Series A investor. It can be longer. It can be a lot longer. It can be 10 to 15 years. And some of the feedback loops in terms of what you're learning, you don't know whether you make an investment now really until 10 years time, whether that was a success. You have lots of pointers along the way, and you can see when you can definitely see when things have failed. But the trying to grow a whole asset class of investors is challenging, and knowing for investing in a startup is one thing. You're investing in both the founder and the product and their dream and their vision. Investing in a venture capital fund is investing in people only. They don't have a physical product to sell. They are, they have a value proposition, and you're trying to test that and get as much reference to schools. But it is hard. Like and then again, balancing that sort of objective of commercial returns, especially in the Elevate side, we are trying to get much more sort of high level commercial returns, because we want to prove to the institutional investors like the KiwiSaver funds that this is worth investing in. But at the same time, we're investing in a very nascent market, and it takes time, and we are seeing maturity now. But I think we're pretty aware there's also been funds that haven't quite worked out.
So what are your thoughts on how KiwiSaver funds could be investing into this space? We've seen a taste of that, I guess, in recent times, but there's probably a much bigger opportunity.
Yeah, and I hear varying numbers. I think the KiwiSaver balances in New Zealand, the latest I heard was 125 billion. I think it might be a little bit higher. We have seen some KiwiSaver funds go into it, the likes of Boost, who are doing their direct sort of technology fund. You got Simplicity doing a little bit. You got Generate doing things, Fisher Fund. So we are beginning to see some emergence in that. But when we look at it, there's such a huge opportunity of that 125 billion. A very, very small amount would make 1% of that, $1 billion going into startups, via venture capital funds would have meaningful impact. And when I look at it from a sort of pure corporate finance lens, I do look at some, especially the biggest KiwiSaver funds, and say, well, globally, I see much higher allocations to alternative assets. By that, I mean infrastructure, property, private equity, and then venture capital is kind of sort of the riskiest bit at the bottom. And we're not seeing big allocations. I think the highest in any KiwiSaver fund is 3% to alternatives, full stop. And if we're not getting, and I think globally it's more like 20 to 30%, 15 to 20 in some jurisdictions. So the question is sort of did New Zealand KiwiSavers investing in more to those? Because if we're not investing in alternatives, full stop, and I'm talking proven asset classes like infrastructure and property and private equity, then they're never going to invest in venture capital, which is sort of the riskiest stage. So that's one key question to ask. Venture capital itself, like there are genuine reasons it is still risky and it's still unproven in New Zealand, but it doesn't mean that's the same in other jurisdictions. So, Australia, there's more of a track record. So one of the things we're sort of exploring, is there a sort of a product which would give you exposure to Australia and New Zealand venture capital funds, which is a less risky proposition for institutional investors. And that would really move the dial. But there are sort of questions around generally why we're not having greater allocation to alternatives, let alone sort of venture capital.
Yeah. Okay. What do you see in terms of, the appetites of individual, Kiwis? Do we see, say, platforms like Sharesies, where people are jumping in and investing in the Rocket Labs and Teslas and Meta and all these sorts of generally listed companies, and then folks involved in Bitcoin and crypto and so on, but it still doesn't seem that easy for the general public to get involved in investing, in our earlier stage companies.
Yeah, and there are a few reasons. I think, and it's I'm sure Sharesies can give you a better answer than this, but my understanding would be that most people investing in shares will be investing in US tech stocks. Over the last sort of few years, the returns have been pretty phenomenal, or more broadly, established US markets or global. There's also been a heavy reliance in New Zealand on investing in properties, we all know. So, and I'm beginning to sort of see maybe that potentially sort of shifting down, especially as property prices have been, well, certainly not making the returns that people were used to. And that's one of the things we'd love to see, is actually people sort of moving away from what we call non-productive assets, investing in a house or that isn't sort of growing the economy, isn't actually creating jobs and having meaningful impact. That would be phenomenal. Buying a house is a cultural thing as well as and an individual thing of people want to own their own house. You also can leverage a house property, which you can't do in any other kind of asset class for the general public. So yes, we'd love to see people moving away from doing that, and at least a portion of your sort of investment, because again, these are high risk assets and different stages of different risk tolerances. So it's not for everybody. You shouldn't. I certainly would not be recommending putting a large chunk of your investment of your sort of entire net wealth into. And I'm not. This is not financial advice, just to be clear. But it is risky. Let's be honest about it. That said, a lot of people want to do good, and they want to do good for New Zealand and want to invest in helping lift. Or investing in really cool stuff. Like, let's be honest, it's investing in nuclear fusion or rockets is quite fascinating. But I think the general public don't know a lot about it. I think I live somewhat in a bubble, and I talk to all of my sort of people around the startup world, and we know about these sort of small little companies that are growing. We're really excited about them, and there's amazing water technology over here or zinc recovery over here. But if I go to a barbecue outside of that world, it's like, I might have heard of Rocket Lab and I might have heard of Zero. And that's one of the things we need to shift that mindset of, just because they're huge opportunities. You can either go and work for one, you could invest in one, you could be buying their products in your company. There's all sorts of different ways you can be helping. You can just be, helping out a company as they're forming and sort of getting ideas. If you've got business knowledge that could be appropriate to an early stage startup, you don't even need to be putting capital into that. And a lot of that's where the best angels are. They're investing and giving their own time and expertise. So there's huge opportunities. And as I said, Rocket Lab, you go and work for them. People have become millionaires and also doing amazing groundbreaking work. And OpenStar will be the same. There's going to be some of the most groundbreaking science in the world. And we see that across the whole country, whether it's medical devices or clean tech or software and AI. So huge opportunities for the general public to know about it. And it's hard. I haven't got a budget to go and do a mass marketing campaign. But I think if the general public begin to know about these things, it becomes a vote winner. So governments start investing more into this space and investing more into R&D and science and allowing people like us to do more. You get KiwiSaver, people voting with their feet with their KiwiSavers. Like, why are you not investing in this part of the sector? And I think that's an important part of it. And I think we've seen globally, actually, a big marketing campaign isn't going to shift the dial. It's actually the successful companies that move the dial. It's people suddenly realizing, I know someone who worked there. I know someone who worked at Zero. I know someone who worked at these other companies. So Halter or wherever. So
OpenStar is an interesting one that you mentioned, because it is probably one of those edgier type investments, right? That kind of does very much sort of fit the profile of, hey, at one end of the scale, it could, if successful, then easily $1 billion business. Who knows what makes $1 trillion business? I'm not sure there's kind of a cookie cutter for that, but on the flip side, there have been lots of others trying to do somewhat similar things. For those that aren't familiar, what can you tell us around OpenStar?
So I will caveat this with, I am not a technical expert. So OpenStar is essentially trying to, nuclear fission, which is how nuclear reactors work generally around the world, split atoms, and it creates a huge amount of heat, which then heats water, which turns turbines, which creates electricity. Fusion is about containing those not nuclear atoms, and I'll come back to that. So creating, combining atoms, bashing them against each other, so bringing up to huge amounts of heat, huge amounts of speed, so they are beginning to fuse together. And that creates the heat that you need. The temperature I think they're aiming for is 150 million degrees.
So we're talking about creating the sun here.
Essentially, redoing what the sun does. So that is, and
slightly smaller scale,
hopefully, and slightly more contained. So and then again, that heat then will create electricity. When it's fully working and up to speed, it will be using sort of hydrogen atoms and isotopes. So they've got to the very first stage, and what they have to do is then contain this heat, because obviously that's recreating the sun in the middle of Wellington is probably not the safest place. So they have created using superconductors that were essentially developed out of another Wellington government-backed research lab. They've now got the ability and the magnets to be able to contain this, and containing it also allows you then to sort of increase the heat and increase the propensity for fusion. So they're using something called a levitated dipole. They are trying to contain that plasma with relatively less magnets than other technologies who are trying to do the same thing. So most of them are sort of creating big donuts that you've probably seen on sort of science papers and things. So it's a different approach, which was, I believe, sort of originated in the 60s. At the time, they didn't have the technology with the superconductors. Now we have the superconductors. So they're hopeful that actually all the sort of stars are aligning, if we sort of use that pun. And they've got to 1 million degrees in terms of their plasma. In their views, they've sort of done some of the hard things. They've definitely done some of the things that everyone said was impossible. So that's a pretty good start.
That's pretty cool, isn't it?
Yeah, and then so the next stage is to go and build a bigger one and start scaling it up, start getting to higher temperatures, and it's pretty exciting.
Yeah, it's a really good good description. I put you on the spot there, so
Right.
I hadn't warned you, but I think it is fascinating to hear about some of these incredible startups that we do have, and telling their stories is an important part of that, and in terms of getting to raising more capital over time, that becomes easier the more we share these stories, right?
And that's huge amounts of capital. Those things are hundreds of millions of dollars to raise before they've seen a penny in revenues, and that's one of the things New Zealand's really good at. Is we call it deep tech. So it's science, whether it's a medical device, and one of our portfolio companies is literally developing a coupler to join arteries together, so that surgeons don't have to stitch half an hour per artery, through to ag tech, so halter, for example, with their collars, which means farmers can actually control where the cows go without having to build fences, and they can control which fields they're doing. Clean tech, we've got there's a growing portfolio of amazing clean tech companies where it's Aquafortis, which has created a way to clean water without using lots of thermal energy and heating up water, which is the traditional way, and it's now cheaper. They can do it cheaper. To Zincovery, recovering waste from electric arc furnaces, and Mint Innovation, recycling power circuit boards. Huge sort of opportunities there. But all those companies require developing a process or product which either has to be sort of regulatory approved through, generally the FDA in America, or a lot of safety tests, or actually just, proving to someone at scale it work, or making it work at scale. And that can be 10 years, and you obviously don't get a single dollar of revenue until you've actually got a product you can sell, as opposed to a software business, which, especially with AI, some of these things can be people spinning up in a matter of hours and selling to the market.
Yeah, that's I guess part of the journey and part of the risk, isn't it? When you look at, I guess, the KiwiSaver type investments and so on. Yeah, most of us kind of like to be able to see the growth of investments, and obviously when you invest in, say, share markets and property and so on, those things are reasonably easy to sort of track and put valuations on, but it's actually pretty hard, isn't it, to put valuations on firms that may or may not make it, and they can flip from one day to the next, up or down, quite significantly.
And it can be binary sometimes as well. Something's going really well, doesn't get FDA approval, or they try to scale it and actually can't scale to that next stage, and it's back down again. So it is incredibly challenging. And again, I'm not giving financial advice here, but you wouldn't ever. That's why you would only do it as part of a balanced portfolio. You'd be having a small sort of portion of your investments in this space, which is the high risk, high reward kind of outcome. And as I said, we call it sort of, not we, but it's called power law. A few big winners will hopefully offset all your losses. But if you miss that one winner, that's also catastrophic as well to your portfolio. So it is hard.
Yeah. Now, on the harder side, one of the one of the challenges for you is picking who to partner with and who to invest in. One of the stories that sort of came through in the media, and some, there's some a blog post or two out there and bits and pieces, was around Hill Ferrant's VC, which was funded by Rob Vickery. I think we had him, if I recall correctly, on a sort of panel discussion that we ran on Clubhouse during COVID, amongst a range of other voices, and at that stage he seemed to be doing some pretty positive things. But I think he sort of left the country a couple of years ago. NZGCP had made an investment in Hill Ferrant's. That's probably got some negative some negative press.
Yeah, it certainly has. Yep.
Maybe you can sort of tell us from your perspective what that journey kind of looked like and how things have sort of steered since to be able to move forwards. With those startups that we're invested in.
Yeah, as I mentioned earlier, we through the Elevate program, we invest in a bunch of emerging managers, and sometimes we do need to grow the market because ultimately to grow the number of startups, we need more capital. Therefore, we need more managers in that. So we have been investing in a range of local and managers that have sort of come from overseas with experience, and ultimately we did. After quite an extensive sort of due diligence period, we chose an investment in 2022, into Hill Ferrant's, and we invested $17.5 million. And yeah, I think has been played out in the media. Like it didn't go to plan. Rob ultimately decided to go back to the UK, and so as a result, NZGCP decided sort of on behalf of other investors to step in and got investors approval to do so, but to step in and manage that fund. So we're now managing that fund, and we're managing on a portfolio. As you said, Rob had done some really cool companies in that portfolio, a lot of gaming companies that a lot of people weren't doing at the stage and still aren't, to be honest. There's a lot of it's another sort of gap in the market where we see. And so we're now managing that portfolio on behalf of all the other investors. I can't get into too much detail around sort of what went on behind the scenes. I can assure everyone that we take our responsibility to invest taxpayers' money very seriously. We had done extensive reference calls. We had done all the same processes we do for all our funds. But sometimes things don't work out, and same reason, startups don't all work out. There are any manager is investing in that super high risky portfolio. The portfolio is actually not doing too badly at this stage, but it's a broad portfolio.
It hasn't gone to zero, has it?
No, certainly hasn't. No, and there's
because I think what I think they were maybe had in the direction of 36 million invested.
Yeah.
What would you say that kind of sits at now in terms of? I mean, it's hard to the value.
Yeah, it's getting back up, sort of around that $36 million. It's not. Yeah, we are confident is not a good word. We are hopeful and sort of expect that we'll hopefully be returning money to shareholders, to all the investors in that. Hopefully at least what they invested. So it certainly isn't. It certainly hasn't gone to zero.
Yeah. And I mean, there were sort of allegations of misappropriation of funds and so on. I think that it had come through from Hashbone, as a Hashbone Interactive, Hashbone, who game developers. Do you think that was more maybe an emotional sort of thing, or did you? I guess did you find any sort of evidence of money being stolen as such?
So on the Hashbone thing, my understanding of it was that it was money that was promised to be invested that was never invested.
Right.
So not technically stolen. I don't think that's the right framing of it. I think it was a lot of hope that there would be follow-on investment, and like all of our sort of anyone who invests, you're hoping it does well and you invest. And sometimes you don't have the money, or for other reasons that investment doesn't happen. But I don't believe it was money that was sort of taken from that company. That's my understanding. In terms of the Hill Friends Fund, I can't get into detail. All I can say is, which I think I've mentioned publicly, we did as part of sort of taking over the fund. We obviously had to do some investigations into things, and there's processes still underway. So therefore, I can't really talk much more about that one, unfortunately.
Yeah. Okay. No, appreciate you, sharing on that. In terms of how you deal with startups where it doesn't go so well, most Kiwis would see that as well. This represents us. This is a government entity investing government funds. It is obviously the nature of startups, but what does the picture kind of look like when that doesn't come out with the huge returns and so on?
I think what's been really encouraging is actually over the last few years that narrative has changed a bit. There used to be a big sort of, and there still are occasionally sort of media stories of quite high profile startups failing, but I think we've matured as a sector, and I think people understand that if you're aiming for big things, sometimes there's going to be failures, and probably more often than not, there's going to be failures. And we will keep reiterating this. Yes, that hugely disruptive, successful company is fantastic, but to get there, you've had to back a lot of companies that didn't get there. And I think as long as everyone understands the purpose of what we're doing, and that is our objective, is to grow, not just startups, not just the capital that goes into them, but actually for New Zealand and for the productivity of New Zealand, for the economic benefit of New Zealand, and for the people of New Zealand. That is why we're doing all this. It's not about making rich people richer or backing fanciful ideas. It's about having a deliberate attempt to grow everything for New Zealand and drive that change through innovation. So yes, companies will fail. It's on what really matters is the personal side of it. That's really hard. People are putting their life and soul into these businesses. The founders who we're backing are incredibly brave. They are challenging, giving up, often well-paid jobs to go and work for very little money, especially at the beginning, with a hope that they, get rewarded eventually. Most of them are, the vast majority, in fact, we generally don't look at anyone that isn't, is impact and purpose-driven. So they're doing it for a reason. They want to change the world. And when it fails, it's hard. It's incredibly hard. And the only thing we can do is be as empathetic and support them. Sometimes, things are played out in media, and people, rightly or wrongly, they want to make money from their investments, so they've a lot of people have financially invested into these things, and when it doesn't work, it can be emotive as well. But I think as long as you've gone in with the right purpose, and we do have strong systems and procedures to make sure that these things have the best chance of being successful. To the extent you can when you're investing in super early stage ideas. So that's our constant challenge is trying to back the bold and the brave, but also mindful. Obviously, we are custodians of money, but I think we've shown that we've returned more than the money the government's put in so far, and I hope that will continue. And Elevate again is it's worth more than the investment we've put into it, so it's tracking well. I think it's over, at least on a gross basis, over 10% up on what we've invested. So we're not actually making money and we're doing impact, which is a pretty good combination.
Who are the sort of most recent startups that you've invested in, or funds that you've invested in? Maybe you can sort of walk us through some of the newest ones. Contented and others that are quite recent.
I was going to say Contented is the one that sort of springs to mind on the AI basis. Lucy and the team there have created something really exciting and really sort of got off the ground and got a lot of customers really quickly. It's a really fascinating product, and we're really excited to back them. And my mind suddenly goes blank of the other recent investments on the direct side. On the Elevate side, most recent investment was into Altered Capital. They are doing, and actually they also invested in Contented, and they're, I won't name. They've got a couple of very interesting investments coming up, which I don't think have necessarily been named publicly. So they're looking to sort of get another $100 million fund. So our $25 million will be matched by 75 million, hopefully, of it may be more of private capital. Another fund we backed in last year was Outset. Their fund 3. And so, that's our first investment into Outset. They're doing a lot of deep tech stuff like ternary kinetics and OpenStar, in companies that are sort of, much more deep tech focused. And they've got an investment committee made up of Sir Peter Beck from Rocket Lab, Sean Simpson from LanzaTech, and then Will Barker from Mint Innovation. So, so seasoned founders that have sort of been there and walked the walk as well. We've got a couple more funds in the pipeline, a lot more sort of direct side on that, the pipeline's been pretty busy in terms of both the direct and the fund to fund side.
Yeah, I think it's a interesting position that you're in. Having the fund of funds where you're able to invest. With the likes of Outset and other VCs. How do you kind of look at that landscape, now in terms of where we are and how mature our venture capital landscape is in New Zealand?
It's come a long way. I think if I look back sort of even the 5 or 6 years that I've been doing at NZGCP, the market is much deeper and broader. We've got a broad, number of funds now sort of growing and on their second or third vintage. So when I say vintage, a fund generally sort of raises with the idea of investing over the next 4 to 5 years, and then the next sort of 5-10 years of sort of collecting, hopefully getting the returns from that. So every 4 or 5 years they raise a new vintage or a new fund to invest in the next cohort of companies or portfolio. So we've now got funds that are onto their second vintage. They're getting to the point where their returns are beginning to come through from the first one. And that's what investors are looking for, more institutional investors in particular, is a track record of actually, it's nice having valuation uplifts, but it's even better to have cash back. So that's what we're beginning to see. So we've got a growing cohort of that. We're beginning to see some bigger funds, so it's $150, $250 million funds. And we're beginning to see a broader range of sort of first-time managers coming up. So in our view, we need to sort of keep building that the cohort of emerging managers or first-time managers. And we've got some ideas around how to potentially much smaller checks, but more sort of, and helping more and sort of the operations piece to sort of help small funds get off the ground, because it's really hard to raise your first fund because you've got less track record. And then we keep doing Elevate and sort of raising the bar of the quality of managers through there as well. And then eventually, we hope then there's a cohort of enough managers with established track records to for institutional investors to come into this, and then that's when you get like a dial up of actually how much money is going into this space. Because I think we're massively under scale. Like we are, we need billions of dollars going into this sector to really scale up these businesses, and especially if we grow the number of startups we have to 5,000. So that's the venture capital market, and it's a long journey, as I said, but I think our intention is that our funding is a temporal fix. We're there to keep catalyzing it until there's enough established managers, and the other thing is we want to try and bring in more investor capability from overseas as well. So we're thinking about ideas of how we can potentially do that as well. So we'll get there, but that'll take realistically 10 to 15 years, I think. But the idea is we make ourselves redundant on that process, and the private market is then taken over. Aspire at the early stage is much more of I think it's a long-term intervention. I think it is something that, same reason governments fund pure research and science, and same reason they give grants, same reason they do R&D tax credits. I think investing in that early high-stage risk space is something that doesn't go away. It doesn't suddenly become less risky, even if there's more money in. So I think there'll be a need for that. You can incentivize people in different ways. Tax incentives has been done overseas and things like that as well. So those pieces. So that, and then on that side, we're looking to go potentially a little bit earlier as well. So right at that sort of proof of concept, like small checks, just to allow companies to get that first sort of tick over, and then get, hopefully there's more private investors then sort of with a risk appetite to invest a little bit further down the line.
Yeah, you mentioned Outset. Maybe you can tell us a little bit about the other funds that you've invested in, and what are your views on the different ones in the landscape? Why have you made those investments?
Yeah, there's a broad range. We've so we started off when we in 2020. A lot of our investments were what we call generalist funds, and so they're funds that will invest in any sector, whether it's software, medtech, agtech, and to be fair, that sort of New Zealand is still a relatively small country, and general consensus is that most funds will be generalist. It's quite hard to be super specialist when you haven't got as many startups as a Silicon Valley or overseas jurisdictions. So we did initially quite a few sort of generalist funds. We did like the Movacs, Blackbirds, GD1, and Movac and Blackbird. They were more mature, and they have now sort of progressed to the point where they don't really need us. Like, in a way, I'd quite like the commercial. Well, I would very much like the commercial returns from investing in those more established managers. At the same time, that's not our purpose to exist. So it's sort of that trade-off of, obviously, good commercial returns also means we get more money to recycle into the next vintage. So that's great. But at the same time, we're there to support emerging managers. So they're still going, still doing very well. GD1 and Pacific Channel, for example. Sorry, I'll keep on the generalist for now. The GD1 is now sort of maturing up. They've got some really interesting portfolio companies, a broad range of startups. And then we also, at that sort of stage, we said, well, actually, we're seeing quite a lot of deep tech companies in the market. So maybe we back a few more sort of deep tech specialist VC managers. So that's the likes of Nuance, Pacific Channel, and more recently Outset. And I think that's been really helpful. We've seen more companies more deep tech companies being funded. And Aspire, we sort of also focus more of our capital into that early stage deep tech side of things as well. So we've seen a shift, and it's getting more towards sort of 50-50 deep tech. When we started, I think it was more like 70% software, 30% deep tech. So it's definitely shifted that. And that's capital also, which, the government invests heavily in science and research and innovation. So having the capital there to support those companies. We're now rebalancing a little bit. So we're going back to sort of a few more generalist funds. So we're looking at Altered Capital as more of a generalist later stage company. So again, it's for us, you invest in a venture capital fund which has its own portfolio, but as a fund manager, you also have to have a portfolio of different managers, different stages, different risk appetite. So Altered Capital is more of a slightly later stage than, for example, a Pacific Channel. So we try to kind of balance that sort of risk amongst our portfolio. And then also where we can be the most impactful. So where does our leverage? If we invest, does it crowd in much more private capital? And we've been quite successful in sort of bringing 3.5 to 4 times as much money as we've invested so far.
Yeah, that's encouraging. In terms of where you see things going from here, and what are the sort of things that you would be or your board might be sort of nudging the politicians on?
New Zealand should have 5,000 startups. That is based on global comparisons around similar sized countries and populations. So we look at us, compare ourselves to Victoria and Australia, not whole of Australia, but similar sized states to New Zealand or Ireland or Singapore. And we think around about 1,000 startups per million population. So about 5 million. That involves deeper markets. That involves every single element has to sort of work together. So you have to have more companies being formed through the science system, but also from spin outs from large companies, from increased risk appetite from people leaving corporate jobs to go and set up startups. Then you have to have the talent building around that, the accelerators and immigration. There's a whole sort of, all of these sort of impact every single kind of part of government in a way. Like it's immigration, it's education, it's science system, it's capital. So 5,000 startups is what's appropriate for New Zealand. We call this the 5 5. So we think that would need roughly $5 billion of capital in the next 5 years, not government capital, just capital in the market. And we think those startups would create 50,000 jobs, $50 billion of economic value. And actually, the initial number was the $5 billion is less than 5% of KiwiSaver. Realistically, it's probably it's an even smaller percentage now. And then if you add in some of our big sort of superannuation funds and ACC, as a percentage, it's quite a small amount, would move the dial.
Yeah.
And this isn't something we can do on our own, and we have no intention of doing it on our own. We're 20 people working really hard in the capital elements piece, but we've got a lot of people really, really aligned with us. We've got all different government agencies, whether it's NZTE and Invest NZ and MB and NZ Super Fund and some of the public research organisations. We all believe in this. We all believe technology is the future for New Zealand, and we all want to work together. We're all hugely passionate about the impact it can have. So, and sometimes it doesn't need a government mandate to do this. We just want to get on and do it, and hope everyone else can sort of join in, because it's the opportunity is there. Like I said, we've got the raw talent. If we didn't have that, I'd be more concerned. But I think we have the ability and the entrepreneurship to do it. So that's what we want to do. In terms of NZGCP, I think we want to sort of slightly broaden our offering to make sure we're sort of covering some of the gaps. Still very focused on investment as the vehicle. We are doing more on terms of investor capability. So we launched a learning platform last year called Venture Ed, which is around helping VCs sort of learn from each other, learn from sort of best practice globally. And we might extend that sort of to other we will extend that to other investors over time, whether it's angel investors or later stage sort of institutional LPs. So that's on the capability, and then also on the connectivity as well. So just trying to get everyone talking to each other, building bridges to, Australia is a natural place for some of our startups to be looking to raise capital, and for some of our investors to be sort of talking to their sort of peers overseas as well.
Yeah. And I think I saw on your website a sort of a directory across the sort of startup ecosystem. What can you tell us about that?
So we sponsor a platform called Dealroom. Dealroom is a global independent platform.
Right.
It's jurisdiction by jurisdiction. So for example, in Australia, there's Dealroom for Victoria, not the whole of Australia. New Zealand is small enough that we get our own sort of deal room for the whole country, and that is the idea is to share data and access to help people understand what, if you're a startup, where to go for a grant or go to which investors are available. Hopefully, if we can get more startups on there as well, it becomes a sort of like a job board for both a job board, actually, a real job board. So startups can advertise they're looking for certain people, certain skills, but also can sort of almost be a marketplace for when they're fundraising, so that investors know sort of who's who in the market. And then we publish a whole bunch of data, which then sort of says what's going on in the New Zealand ecosystem, but then how does that compare to global benchmarks across the world. And that's where we've got some of the data around how we're actually punching above our weight in terms of unicorns and decacorns, actually. So $10 billion businesses that are per capita, we're above global comparisons.
Yeah. Okay. Oh, that's interesting. And is there a little bit of crossover with some of what Technology Investment Network are doing, but it's just you're kind of getting some similar information in terms of part of what you do there?
Well, and one of our sort of key initiatives for this year is to kind of refine our data and AI strategies to take the burden off investors in particular as much as possible. So working with other groups, we've worked with Technology Investment Network last year to do a sort of deep dive on some of the startup economic outputs and things like that. We're not trying to own the data, we're trying to collaborate. And the more data we get, the more proof points we get of the impact of this, the easier it is to crowd more capital into it. So yeah, absolutely, we're keen to work with whoever we can, and and Dealroom is more of a sort of open source platform that anyone can sign up to. It doesn't have a paid subscription or anything like that.
Yeah. Anything else you'd like to add into the discussion before we finish up, James?
Really want to say, first thank my team as well, because this is certainly not me doing all this stuff. This is my team doing all this stuff, and they're doing an incredible job and really passionate about growing the sector. And I think a shout out for the opportunity, really, because this sector has so much potential, and we all just need to get behind it and share stories with our friends, people who don't know about these things. And this can be the barbecue chat or the fireside chat over a glass of wine. So let's spread the word.
Yeah, no, that's good. And look, I guess across our listenership from the C-suite through to students, we've got a whole mix there. Any particular advice or comments that you would share?
Yeah, we'd love to see more corporate venture in this country. We're massively underrepresented, and some of this, some of the companies we're talking about they're the ones that have the ability to disrupt your business. So why not get involved with them early? The startups can move a lot quicker and can actually be meaningful ways of transforming larger companies who don't necessarily maybe have the innovation engine of a startup. So it's about working in partnership. All this is about working in partnership, and there's huge opportunities there. I think for the students, just to raise awareness that this is a sector that exists. The tech sector exists in New Zealand, and there are great jobs. So if you're passionate about art or design or engineering, there are jobs for you in the tech sector in New Zealand. And if you don't know about them or where they are, then have a look on our website, talk to peers. Angel groups are obviously quite a good place to sort of go along and understand, and they're definitely keen to get more younger people sort of invested and looking into these startups. Search on LinkedIn and Technology Investor Network, Technology News. There is lots out there. It's sometimes a little bit hard to navigate if you don't know the sector.
Yeah.
But trust me, there's stuff there. There's some really cool stuff there.
Excellent. Oh, well, thanks for taking the time out to join us on the New Zealand
Pleasure.
Tech Podcast. Thank you,
Thanks for
James. And thanks, everyone, for listening in. And, of course, a big thank you to our show partners, Gorilla Technology, Fortinet, Workday, Spark, 2 Degrees, and 1NZ. And, of course, lots more episodes to listen to. Of course, if you've been listening to the audio, make sure you're following us on video platforms. If you've been watching video, find us on your favourite audio platform. And be sure to check out the New Zealand Business Podcast episodes. We've got some fantastic interviews on there that are very much in the tech sphere. Not all of them are, but certainly there's plenty there to partake of. So thanks everyone for listening in. We'll catch you on the next episode. See ya.
The New Zealand Tech Podcast, brought to you by Gorilla Technology, proactive and strategic IT.